Hi, thank you for watching Dig Into China. I'm Dong Sean. The world is nervously watching as the Chinese real estate giant Evergrande flails. It has missed 3 bond interest payments in the 3 weeks. On Tuesday, October 12th, it missed its 3rd round of bond payments in 3 weeks. Market is fearful over contagion involving other property developers as a wall of debt payment obligations come due in the near term. Some bondholders said they did not receive coupon payments totaling $148 million on Evergrande's April 2022, 2023, and 2024 notes due. Chinese Communist regime may manage to prevent the burst of the real estate bubble, but China's economy isn't heading for more sustainable growth. It is obvious that China's political economy under Mr. Xi has become even more unstable, even as Beijing grows more impatient to displace America as the dominant power. I do not foresee the global financial market will repeat 2008 crisis when financial institutions lost faith in each other. China's financial system doesn't work this way. Loss of faith in the commercial worthiness of other entities isn't fatal. Instead, banks and other financial institutions could continue to lend if it's instructed to do so by political masters. For example, in 2008, during the financial market meltdown, China's export to North America and Europe stagnated. Chinese state-owned banks injected about $15 trillion of new capital into the economy for fixed investment projects over the next 6 years, 15 trillion with a T. This was about 1.5 times the size of the entire American commercial banking system at the time. Since then, politically driven lending has become a feature of the Chinese political economy. In order to reduce bad loans on lenders' book, CCP often forcibly roll over or deferred loans and bond payments to ensure there is no or minimal amount of non-performing loans and defaults. State-owned and even private firms are compelled to purchase bonds issued by moribund corporate entities. In other words, what determines liquidity in Chinese system are political, not commercial factors. Therefore, CCP can and will avoid a Lehman Brothers moment. The fact that Beijing has not rushed to Evergrande's rescue doesn't mean that Xi Jinping is serious about deflating a dangerous real estate bubble, breaking the economy's addiction to debt, and to prevent a terrifying reckoning sometime in the future. I doubt it. Mr. Xi might want to achieve all that, but in reality it is impossible. 1/3 of local government's revenues are used to derive from land sales and real estate transactions. Since pandemic, more than half of the revenue for local governments have come from property. Local governments are responsible for providing around 3/4 of all social and public goods, such as hospitals and schools. The central government fears this. As I said earlier, what determines liquidity in China is a political, not commercial factor. If the faith in the political factor is failing, that spells trouble for CCP. Trouble, trouble. This means that the political economy will remain largely unchanged, even if Evergrande is allowed to fail. Xi Jinping's pledge to reduce inequality by cutting down billionaires such as Evergrande's Xu Jiaying is a smokescreen. The primary cause of inequality in China is entrenched privileges for state-owned enterprises and the well-connected at the expense of the truly private economy. Until discrimination against the private economy is reduced, wealth won't be better distributed, and household income won't increase enough to drive and sustain the domestic consumption-led growth promised by Chinese leaders. The political economy is the root cause of China's rampant inequality. In order to achieve common prosperity, CCP must go. Unfortunately, it is not going to happen under Xi Jinping's watch. He is zeroing in on the ties that the state-owned banks and other financial stalwarts have developed with big private sector players. Some officials said Mr. Xi's goal is to make sure the party exerts full control over the economic lifeblood of the country, preventing the financial sector's capture by big private business and other power players that threaten CCP's influence. If you are thinking of investing in China, I have two words of advice: do not. Because this political economy is too unstable and unpredictable. Executives, companies, and entire industry formerly favored by the ruling Communist Party have been stripped of power and wealth without warning, making foreign investors look like fools. What about I follow professional investors and the smart fund managers? Do not. Even if the smart money do have special insight into what the Chinese regime is going to do next, they won't be able to act on it. Since its peak in February this year, the MSCI China Index has lost 30%. Even the long-term investment prospect does not look good. MSCI China Index was created at the end of 1992. Since then, it has returned an average 2.2% annually. That is including dividends. Over the same period, the MSCI Emerging Market Index grew 7.8% annually. The S&P 500 Index, 10.7%. That covers almost a 30-year period in which China enjoyed a double-digit growth rate. If you invest in U.S. Treasury securities, you will have much better return than on Chinese stocks. No wonder China holds $1 trillion U.S. Treasury bills. To know what CCP is thinking is particularly hard. Without warning, Xi Jinping personally halted the initial public offering of Ant Group. Since then, the government has slammed Alibaba with $2.8 billion fines. It blocked the ride-hailing company Didi from adding new customers just days after its IPO. In July, Beijing issued a new edict that forced tutoring services for children to run as not-for-profit, wiping out 70% value of New Oriental Education and Technology Group and the TAL Education Group. Many analysts, commentators are calling China's recent action a regulatory crackdown. It is not. Andrew Foster is the Chief Investment Officer of Seafarer Capital Partners, a global asset manager. He said, "These are not regulatory events. These are policy intervention to reshape Chinese society guided by Xi's personal agenda, intended to effect objectives that aren't always noble." Very true. I can't agree more. You can invest in China again when Beijing stops using the stock market as a plaything. Until then, do not. Thank you for watching. Please leave a comment and subscribe to my channel. Just click the subscribe button right here. I'll see you again shortly.